Have you ever wondered how to invest in the stock market? It's a world that might seem complex and intimidating, but it's also a place where fortunes have been made. Understanding the stock market is crucial, not just for the big players but for anyone looking to grow their wealth. It's a game of strategy, patience, and a little bit of luck. But don't worry, it's not as complicated as it may seem. Well, you're in luck because today we're breaking down the process of investing in the stock market into simple, easy-to-understand steps. First off, it's essential to understand what stocks are. Picture this. You're at a local bakery that makes the best pastries in town. You love it so much you wish you owned a piece of it. That's essentially what stocks are. They are shares in the ownership of a company, just like that bakery. When you buy a stock, you're buying a small piece of that company. This gives you a claim on part of the company's assets and earnings. Assets could include everything from buildings and machinery to patents and brand names. Earnings, on the other hand, refer to the profits that the company makes. The more stocks you own, the larger the portion of the profits you get. So, if the company does well, you do well. Conversely, if the company doesn't do well, your stocks may lose value. So, when you buy stocks, you're essentially buying a piece of that company. Now that you know what stocks are, the next step is learning how to choose them. Choosing stocks isn't like picking out a new shirt or deciding what to have for dinner. It's a process that involves careful research and analysis. Think of it like detective work. You're looking for clues that reveal the true value of a company and whether it's worth investing in. The first thing you need to do is research. And no, we're not talking about just Googling the company's name, we mean deep, thorough research. Look at the company's past performance, its leadership, the industry it operates in, and its competition. You want a clear picture of where the company stands today. Next, you'll want to understand the company's financial health. This involves looking at a few key metrics. One of them is the company's earnings per share, or EPS, which tells you how profitable the company is. Another is the price-to-earnings ratio, or PE ratio, which can give you an idea of whether a company's stock is over or underpriced. And let's not forget about the company's balance sheet. This gives you a snapshot of the company's financial standing, including its assets, liabilities, and shareholders' equity. Once you've gotten a handle on the company's financial health, it's time to consider its future prospects. What is the company's growth strategy? Are there upcoming products or services that could boost its earnings? What challenges does the company face and how is it planning to overcome them? But remember, even the most successful companies face risks. The stock market is unpredictable, and even the best-laid plans can go awry. So, while it's important to be optimistic about a company's future, it's equally important to be realistic. Remember, choosing the right stocks requires careful consideration and analysis. Investing in the stock market isn't a get-rich-quick scheme. It's a long-term commitment that requires patience, resilience, and a willingness to learn. So take your time, do your research, and make informed decisions. Your future self will thank you. Once you've done your research and chosen your stocks, the next step is to actually buy them. But how do you do that? Well, you'll need to open a brokerage account. This is simply an account you open with a brokerage firm, a company that buys and sells stocks on behalf of its clients. Think of it as a special bank account for your stocks. To open a brokerage account, you'll need to provide some basic information about yourself, like your name, address, and social security number, much like when you open a regular bank account. Once your account is open, you'll need to deposit money into it. This is the money you'll use to buy stocks. So now you have a brokerage account and you've deposited money into it. The next step is to place a stock order. This is where you tell your brokerage firm what stock you want to buy, how many shares you want, and at what price. There are a few different types of stock orders you can place. A market order is when you buy a stock at its current market price. A limit order is when you set a specific price at which you want to buy the stock, and the order will only be executed if the stock reaches that price. A stop order is similar to a limit order, but instead of setting a price at which you want to buy, you set a price at which you want to sell. This can be helpful if the stock's price is falling and you want to limit your losses. Once you've decided what type of order to place, you simply enter the details into your brokerage account and click Buy. Your brokerage firm will then execute the order on your behalf. And just like that, you've bought your first stock. Buying stocks is just the first step. To be a successful investor, you need a strategy. Now let's delve into some common strategies that have been proven to work over time. First, there's the buy and hold strategy. This is a long-term investment strategy based on the concept that in the long run, financial markets give a good rate of return despite periods of volatility or decline. As an investor, you buy stocks and hold on to them for a prolonged period regardless of market fluctuations. This strategy requires patience and a strong belief in your investment choices. Next up, we have dollar cost averaging. This technique involves consistently investing a fixed amount of money in the same stock or index fund regardless of the share price. Over time, this strategy can reduce the impact of volatility on the overall purchase. When prices are low, your fixed dollar amount will buy more shares, and when prices are high, you'll buy fewer shares. This strategy can be a smart move for beginner investors as it mitigates the risk of making a large investment at the wrong time. Then there's diversification, an investment strategy aimed at minimizing risk by allocating investments among various financial instruments, industries, and other categories. It aims to maximize return by investing in different areas that would each react differently to the same event. In other words, don't put all your eggs in one basket. Spread your investments across a variety of sectors and investment types. Remember, the most successful investors are not those who pick the right stock at the right time, but those who have a disciplined strategy and stick to it. They don't let emotions or market hype dictate their investment decisions. So, whether you're leaning towards the buy and hold, dollar cost averaging, or diversification strategy, the key is to stay committed to your strategy, be patient, and give your investments time to grow. A well-thought-out strategy can be the difference between a successful investment and a failed one. It's also important to understand that investing in the stock market comes with risks. Just as the sun rises and sets each day, the stock market inherently carries a degree of uncertainty. No matter how much research or analysis you conduct, there's always a chance that your investments might not pan out as expected. This is why the golden rule in investing is, never invest money you can't afford to lose. It's not a game of chance nor a get-rich-quick scheme. It's a calculated risk where you should only put in what you're comfortable potentially losing. It's similar to planting a seed. You don't bury your last apple seed and hope it grows into a tree overnight. You plant it, tend to it, and understand that it may take time to bear fruit, or it may not grow at all. The same is true in investments. You might experience losses, even significant ones, but it's crucial not to let the fear of loss prevent you from seizing potential opportunities. Instead, use this fear to fuel your learning, to push you to understand your investments better. And remember, patience is key. The stock market isn't a sprint, it's a marathon. It's not about making a quick buck, but about growing your wealth over time. The most successful investors are often those who have mastered the art of patience, biding their time, and waiting for the right moments to act. Patience is a virtue, especially when it comes to investing. So there you have it, a beginner's guide to investing in the stock market. We've journeyed together from understanding what stocks are, essentially shares of ownership in a company, to gaining insights into how to choose which stocks to invest in by researching a company's financial health, market position, and future prospects. We've also explored how to buy stocks using either a brokerage account or a robo-advisor, and discussed a range of investment strategies, from value investing to dividend investing and dollar cost averaging. These strategies can help you navigate the stock market and build a robust, diverse portfolio. And finally, we've tackled the subject of risk. Remember, investing in the stock market isn't a guaranteed way to make money. It's crucial to understand the potential pitfalls and to be prepared for fluctuations in the market. With these steps, you're well on your way to making your first investment in the stock market. Happy investing!